We're going to give it a couple minutes to have people join. Sean, those cabinets are stunning.
And I try and get a matching shirt so I just
I
completely blend
know.
in. You're like,
It
there's just
looks
this talking
amazing.
head.
That's so cool. You just put it in, didn't you?
Yeah, it was a couple weeks ago. I don't know if that was
Wow.
COVID compliant, but we needed a little bit better setup from home here. It was just absolutely chaotic.
Love it.
And I'm noticing that I can see us as presenters, but not everyone else. Is that going to be the case?
Yes, this is a webinar format, so it's just going to be you guys and me.
Well, then I guess hello, everyone can see us, and we'll just
Yes, everyone.
wonder what your
Yes,
beautiful
I see a
faces
lot
look
of
like.
people joining. Shreyas, hi, buddy. Niket. You guys, if you're just coming in, tell us who you are, tell us what you do, and where you're tuning in from. Would love to hear. Use the chat box.
I'll start us off here. I am joining live from Huntington Beach, California. Excited to be with you guys today.
Not jealous at all. Hey, William. I see you're on Vashon. Ryan, where are you today?
I'm broadcasting live from Black Diamond, Washington. Beautiful day down here on Lake Sawyer. Getting ready to have a groundbreaking party for one of our self-storage projects this afternoon.
Wow.
It's crazy. I would have been scheduled to be on Mount Rainier just within the last couple days and headed back to Seattle, but that all got canceled.
Oh, bummer.
Yeah. Oh, bummer.
Maybe that would have been my first attempt at a mountain, so kind of dodged a bullet. We'll see. It was like let's do a bucket list item, but never happened. So yeah, for next year, perhaps.
I was out hiking in the Cascades this morning. A nice hike. Beautiful weather. Very, very nice.
Beautiful weather to do that today.
It was awesome.
Oh, happy early Father's Day to the both of you.
Thank you very much.
Thank you.
Yeah.
Yeah.
This is fun. A lot of Seattle love here. Renton, my hometown.
I know, Sean.
I'm a University of Washington Husky. I'd worked at Microsoft for quite a few years before they relocated me down to California. So it's just fun to be spending time with all my Pacific Northwest brothers and sisters in here.
That's awesome. We love to have you here.
Congrats on the self-storage auction, William. We do all of ours online, and goals to get the tenant out, really. Little profit, but not much.
I forgot to get any questions into you guys, but like while we're waiting to fire this up, I'd be very fascinated to hear from everyone. You just want to type in, like, what is your primary source of income? If you guys are flipping houses or wholesaling or working at Microsoft, life as a landlord, like what is it that's your key source of income? Just so we can kind of put things into context as we're going through the case studies here.
Yeah, that would be great. So if you guys could just go in and put in the chat box, like what is your primary source of income? That would be awesome for like the panelists to kind of get an idea of who their audience is. I guess we'll get started, you guys.
Yeah, let's do it.
We have so much to cover, so I'm kind of excited about this one. Okay, so I'm your host, Leka Devatha. Thank you for joining us this afternoon. We are streaming live here from Seattle, Washington, and it is one beautiful, gorgeous day. So I think for the first time, Sean, I'm not jealous that you're in Huntington Beach, and I'm not. This webinar is brought to you by Real Estate at Work. It's a meetup group that brings together investors and other real estate professionals once a month. I co-host this group with me, Lee, and Albert Bowie, and hopefully we'll see you soon in person. So today's webinar will be focused on two different asset classes: A, shopping centers, B, storage facilities. And I'm looking forward to introducing you to Sean and Ryan, who will give us an overview of their area of specialization and really walk us through real life case studies so you can truly see like what they've been through and what they're doing right now. So what makes these two stand out for me is their entrepreneurship. They're both super dynamic, not afraid at all to push boundaries, and they've both chased after opportunities that are really quite atypical. So let's talk about Sean first. Sean and I go way back. He was my very first mentor when I started my own investment career back in 2014. He taught me three very important things. First, he was the one that taught me to extend my borders, step outside of my comfort zone. And I saw him do it, so he was just like leading by example, and that was great for me. Second, he taught me to constantly network. And his was the very first mastermind group that I was a part of. And three, and I think this is absolutely the most important thing, is he taught me to use social media to my advantage. So even back in 2014, like he used Facebook and YouTube to really make himself relevant. And I think like just looking back, this is so important when you want to put yourself on the map for your lenders, your investors, your private money lenders. So thank you for that, Sean. And really, Sean has done it all. He started with fix and flip and wholesaling and burrs to then went into commercial real estate. So it'll be kind of nice to get an idea of how he made that switch even from residential to commercial. Then Ryan is a commercial airline pilot. He flies for Delta, no big deal. He is also one of the sharpest and wittiest people I have in my network. He just had a baby like 5 months ago, but hasn't slowed him down one bit. Ryan, I don't know if you know this, but babies born in 2020 are called coronials.
Oh my gosh. Oh, 2019. So not a coronial.
2019. Okay, he just
Day
missed
after
the boat.
Christmas. Yep.
Yeah, I see. So Ryan has this insane ability to look past the obvious, and that has like helped him grow his company beyond any one category of assets. He's going to give us an overview on really how he did that. Let's get started. We have like a ton of things to cover. So drop your questions in the chat box and we'll get to them as we do. And let's get started. Sean, if you want to take it away.
Yeah, let's see if I can fire up the screen share here and have technology cooperate. So Leka, let me know if you see the slide here pull up.
I do. It's perfect.
Okay, we're ready. So I can dive on in once you give me the green light.
Go ahead. It's all yours.
Phenomenal. Well, obviously excited to be with you guys today and sharing a little bit of my journey and an exciting, topic to discuss and dive into. And I think I just want to take a moment to, like I say, thank you for that warm welcome. And it was a fun trip down memory lane, but also congratulate everyone for being here and just, prioritizing this part of your life. Like we all have so many things going on and it's kind of a crazy time. And, here we are, thinking about our finances and our portfolio and, the ways that we can provide, for our families and for our communities and really put ourselves in the best possible position. So just, it feels like I'm with my people when I'm doing this. And it's kind of ironic because I'm going to share things with you guys today that I haven't shared with, some of my closest family members, just kind of given the dynamic of this business and some of the numbers. So without further ado, we'll dive into it. And this presentation is really geared for two folks, right? So busy professionals, making money in lots of different ways, who are seeking more passive income for their portfolios, or investors looking to strengthen or fortify their portfolios with the addition of more resilient real estate. And I guess someone could qualify for both of those, but I think that's really what's going to resonate most for folks. And we're going to do that through a case study. We're going to look at a property here in Arizona where we partnered to create more freedom for all the owners through owning commercial real estate together. And what I would encourage you guys to do is just grab a notebook or however you want to take some notes, because I hope that you'll have a lot of questions, which we can take a couple minutes to answer at the end. I'm going to go fast through a lot of stuff to deliver as much value as I can. So definitely scribble all those down, or if you write them in the box, we can come back to them at the end once we get through everything. And so very, very quickly, like my bio or background, for about the last decade, I've done, as Leka mentioned, fix and flip houses, rental properties, wholesale deals. I've done some new construction projects, some ground up, and most recently got very focused on commercial real estate. And so ends up being about 75 deals or so, a little over $20 million in acquisitions. And a lot of lessons learned the hard way. You know, a few fun takeaways that I'll definitely share with you guys. But I've been out there, you know, getting my fair share of scrapes and bruises, and so I'm going to share some things that I think will help make everyone's journey more efficient if you choose to get involved in commercial real estate, and some of the things that I wish I would have done a little bit differently, or that I would coach, you know, my younger self to do, or my kids, or just say, hey, save yourself some time and some brain damage and think about, you know, this methodology of implementation. And you know, growing up, I did not come from a family with a ton of money. You know, my mom really struggled financially. And so, you know, one thing that I wanted to figure out was how do we have a life full of abundance? And, you know, what I was taught was go out and get good grades and get a good job and, you know, kind of grind away in corporate America, and like a very traditional route, like save, save, save. And so that's kind of what the program was. You know, I landed a career at Microsoft, and for many years, I cranked it out. But eventually, I think like a lot of people in corporate, you know, it starts to feel a little bit slow and somewhat like the rat race, right? Like, am I getting ahead? Like, am I really building wealth? There was burnout. You know, as I thought about my portfolio, there's, you know, some volatility in the returns, and it didn't feel like a whole lot of control over what I was doing, and, you know, kind of like a roller coaster of almost uncertainty. And so, you know, I picked a book back up that maybe you guys are familiar with, Rich Dad, Poor Dad. And I just read this and I thought, boy, this has got all the answers. And if I become a real estate tycoon, like everything's taken care of, right? And so I kind of dove into that head first, probably without doing adequate research, and just found out what it was like to learn a business, learn investing, do it initially without a mentor and a lot of help, and kind of life of an active operator. And I think any of us doing real estate now can appreciate the learning curve there, you know, new vocabulary, and the joy of working with contractors, or what I've come to know as adult babysitting, working with tenants, either through property managers or directly in a lot of cases. And so, like, personally, I just started to feel a lot like a jack of all trades on my 10-year journey. And I was like, wow, this is taking a tremendous amount of time. And I'm not necessarily getting to where I'd expected to be financially, or it's taking a lot longer. And so there's some things that I would definitely do differently as I reflected back and you know, put some of these slides together for everyone else to think about. And you know, what I was seeking, and I think what so many of us are, is freedom, right? And I equate that heavily with time, right? The ability to be doing what we want when we want, and then the means or the money to be able to do that. And, you know, as I looked at my business and juggling all these flips and all these contractors and just constantly pouring back money into it, and the team and all the things that were happening, I just really wasn't where I wanted to be. So I hit the pause button. That was about 2015. And I just took a step back.
Sean, I have a question. So how long had you done that? So what was 2015? When did you start?
It was about 5 or so years into it. And, you know, I just realized that, you know, we kind of had some things that I didn't want, right? And I was doing a lot more volume, but not getting the results or the output. And so, you know, my thesis was do fewer bigger deals that were of higher quality, and that, you know, if I could manage 1 or 2 or even 3 of these a year, it could get us equal, if not better, results from what we're experiencing on the single family side.
So I want to stop you right there, because that is such a key takeaway. Because we all, like, when we started, like, same with me, I was like, I want to do 15 flips this year. And boy, I did 15 flips, but 5 out of the 15 were successful. So the next year I had to pick quality over quantity. I did 3 flips and I made more money than I ever had before. So that is so important. Like, just, you know, to kind of edit yourself.
Well, and, you know, for those of us who've read Rich Dad, Poor Dad, you know, he talks a lot about earning as a business owner or an investor, where we're not like trading our time for money so much. And I just looked at my own business, and that was not the case, right? I was probably working more in my real estate business than I was in corporate America. And I don't even think I was making more money. And so, like, fundamentally, it didn't make sense, like what I had built or what I was going towards. And so that caused me to stop and just really be more thoughtful and strategic. And so, you know, I'm talking to the most successful guys that I know and mentors, and I'm seeing them build ultimately commercial portfolios where, you know, the money is just pouring in, and just because of the nature of the platform, bigger deals, economies of scale, it's got an extra comma and more zeros behind it. And so we'll look at that. But you know, that's really what I would encourage, you know, my closest friends and my families to think about is, you know, rather than doing all these little deals or taking all the time or the decade to ramp up and learn, you know, residential and then flip gears and learn commercial all over again, is, you know, figure out how to do it with more leverage. And the more I thought about it, partnering really can allow for a lot of time to be compressed and shortcuts to happen. And so we'll look at that. And my slides are going crazy here because I think they have timed animations, but there's 3 ingredients about commercial that are really interesting. So we'll look at, you know, the asset class and how it can create superior returns, how someone can enjoy turnkey ownership, like be completely removed from it, where truly their money is making money and they don't have to be involved in it, and then how to strategically time it. Particularly with what's going on right now, like it is just a crazy time. And I think about, you know, the term perfect storm comes to mind, or a tsunami of opportunity that's right around the corner. And so there's a lot of crazy headlines, but I think that's also going to create, you know, it feels to me like the opportunity of a lifetime, or at least a decade. All right, so let's just kind of get all this out there. You know, some of the things that we may hear or feel, or certainly that I experienced initially, was, you know, I don't understand commercial. I don't know anyone who's doing it. It seems big. It seems like it's going to take a lot more money. You read all these horrible things about businesses going bankrupt or over. Like, is there more risk? Is it a steeper learning curve? Like, are there too many barriers to entry? And just all that overwhelm as you like flood yourself with it would you know, lead a lot of people to say, you know what, why bother? Right? I've got a successful business. You know, I'm doing whatever I'm doing right now. Like, why spend the time to learn this? And so I kind of had that ignorance going in until I started to understand it more, to peel back the onion and really see what were some of the things that made this so special. And, you know, why do the wealthiest families have commercial as such a big portion of their portfolio? And that's different than folks of, you know, less wealth and means. So I'm going to show you some ways that we've been able to force superior returns. And so I think about that compared to, you know, let's say the stock market, or let's say residential, or let's say some other ways to invest. And one of the most important is the economies of scale. And so with bigger deals, just more things become possible given the size of the project. And you think about hiring the best vendors, hiring a great attorney, hiring, you know, a phenomenal project manager who might be able to spend more time on site there than they could at a smaller property. The ability to spread costs out over, in this case, a 16,000 square foot property. So it's just, there's different things that become possible with a bigger deal. I can spend, you know, a year worth of my time completely focused and obsessed on this, where it doesn't make sense to do that if you're doing lots of little projects. Additionally, I'm going to look for a deal with predictable and substantial upside. So I would write that in my notes. I don't pursue or buy anything that doesn't have substantial value add opportunities. And so in this case, this building, when we bought it, was about 50% vacant, about half full, which means it had half the income potential, which means it was about half as valuable as it could be. So that income and valuation is pretty closely correlated. And so, you know, the business project here is pretty straightforward. Fill up the vacancy, bring the rents to market, and then we've nearly doubled the value of a building. And so that's what we did. We put 3 new tenants in here. I renewed all of the leases in this property and basically brought it up to pro forma value. So, you know, the highest that it could be compared to the properties around it. I select buildings with what I consider to be durable tenants. And by that, I mean, they're essential, they're kind of daily needs, they're more internet resistant. You know, it's not JCPenney's, it's not Sears, it's in some cases mom and pops. You know, in this case, it's an Allstate, it's a restaurant, it's a dog grooming place, it's a nail salon. You know, it's a smoke shop. It's not the sexiest things necessarily, but they're there and people are frequenting them. And if any one of these tenants go out, they're relatively easy to backfill and say, hey, it's a 1,200 foot box. It's a 1,500 foot box. It's kind of like turning over an apartment unit, or if you lose one of your tenants in a duplex or a fourplex, it's not that hard to backfill them. There aren't such a limited amount of users, there's actually a lot of people looking to locate next to a Walmart, where there's a lot of car traffic going by, where there's foot traffic. One of the other things that makes commercial really interesting is triple net rent. If you're not familiar with that, the concept is that our tenants pay for the common area maintenance, they pay for the taxes, and they pay for the insurance. So the real rent rate is almost completely profit that's being received by the ownership group. And then another unique thing about commercial is that not every deal is going to be off market. This one was, but there's less competition. I mean, just do a quick inventory of all the people that you know that invest in commercial versus residential. All the people who are able to buy a multi-million-dollar property versus one that's a couple $100,000. And so I think intrinsically there's fewer people competing to transact on these deals. And in this case, this was a pocket listing brought by my broker where she was allowed to double end the deal. And it was a seller who was very cooperative. They worked with us on seller financing. We had a very good cash on cash return because of that. I was even able to, not have to personally guarantee this loan, which is not going to be the case every time, but there's just, as you stack those things together, it starts to kind of create that unicorn opportunity that isn't every deal. But if I pass on 98 out of 100 projects and 2 of them are home runs that can produce a 7-figure profit, that's okay, right? I can make a decent living, and more importantly, my partners who invest on these projects with us can too. And so you think about, those things that we just went through, the scale, the upside, the nature of triple nets, off market, durable tenants, and kind of stacking those together. That to me is going to be a deal that's worth taking a close look at, that's worth spending the time on, and that's going to yield the results where, an entire ownership group can eat and have phenomenal returns participating in a deal like this.
So I have a couple questions on that.
Okay.
Can you just, for the sake of everybody here, what is a triple net rent?
Yeah, so that's when the tenants pay their share of the common area maintenance, the taxes, and the insurance. And so basically all those costs get passed through to the tenants, and that's part of their lease. They know when they sign the lease what their base rent is, and that roughly $5 per square foot is going to go towards all those other costs.
Yeah, and then another question, when you say seller financing, how is that set up?
Yeah, so in this case, there was no bank involved. The guy owned it free and clear. And I said, hey, I'll put this amount of money down if you will finance the rest. He did a 5-year term. It was interest only. And so it allowed us to buy the deal and on day one be cash flow positive. Not a lot, it was close to break even, but we weren't bleeding the whole time we owned it and added value. Unlike a lot of the flips I did, every day is carrying cost. And so, yes, we're moving as fast as we can, but we're not losing thousands of dollars per month as we add value to the project.
And then, okay, another question. That was great. Thank you for that. You bought this deal off market. Your broker brought it to you. How did you market that you were in the market for something like this?
I think largely like you would for residential. I clarified my buying criteria. You met with the people, and it's an interesting segue, Leka, to the next transition, because I think about the amount of time that I spent on that, and it was years. And there's ways to do it faster, but I think a good thing for everyone to think about is how to do it with more leverage than I did, so that you don't necessarily have to spend your time on some of those smaller value items. And so maybe we'll circle back to that one in just a second. But once we get the deal fully leased up, so we're at 100% occupancy after signing those 3 new leases, we can do kind of that strategy you talked about. You do the BRRRR, we can refinance it, return a lot of capital to the ownership group, and hold on to it for the long haul, or sell it. In this case, we did decide to sell because we liked the numbers. And so what you see there, that parcel highlighted, I sold separately to a donut user. And then an investor bought the big building in the back, the 16,000 square foot. So 2 separate parcels. In total, that sold for $4.9 million. You'll recall we bought it for $2 million and we put about $400,000 into it. So let's say you're into it for 2.5, you're selling it for 4.9. So a little bit more than $2 million in profit that's realized. And that's for the entire ownership group, right? So I get to take the fun picture with the check here, but that amount of money is being split up among Leka, among Ryan, and everyone else that had a stake in this project proportionally with what they invested. And so, really turning around to your friends and your family and saying, guess what, guys, like, we hit a double here, or we hit a triple, and I'm excited to share that your share of it is this amount. So that's pretty special.
Awesome.
It just, when I think about where this was on our kind of journey, it was a quantum leap from what we had experienced before. And how many deals it would take to get us, it would be like buying 12 rental properties,
right,
in a single shot, and doing double or triple what any of my other single family rentals had ever performed before. And that was very much the case for our owners as well. So I don't want to get people too excited necessarily about the returns, but think about this, right? We're getting consistent cash flow from 10 tenants. We're forcing appreciation into the building. We're paying down the loan, or the tenants really are helping to do that. And then we've got tax advantages. And I would write this in my notes, accelerated depreciation / a cost segregation study. And so when we have a building that's valued at $2+ million, it can create substantial paper losses, net operating losses, and that can directly offset Leka's income. And so if she's bringing in $100,000 a year and I can give her $100,000 in paper losses, I can zero out her taxable income, which she might have otherwise paid almost 50% on. Okay, we'll jump to kind of big component number 2, and that's turnkey ownership. And I think a lot of this is possible because, again, the size of the deal, the economies of scale, but all that kind of headache and learning curve that an active operator or business owner is going through gets shifted or put on someone else to deal with for a passive investor. And so, Leka is involved in this. She doesn't have to do the broker negotiation. She doesn't have to negotiate the loan. She doesn't have to oversee the construction. She's just deploying the capital. So really you're shielded from the joyous hand-to-hand combat. The deal's been underwritten and curated, by someone who's been doing it for many years, by my Jedi counsel, by my bankers. We're underwriting it with third-party vendors and reports. She's getting consistent monthly reporting, video updates on the property, local on-site management, and literally, like we always talk about, right, just collecting checks, right? That mailbox money that sounds so sexy, I think is being realized here better than I've seen it in a lot of other asset classes. And so to be able to make those kinds of returns and be truly removed from that situation, to me, is a really special and unique proposition. And I think this is probably one of the most fun moments of my career. And that's just, sharing with, some of our owners what their cut of the deal was. And you can see, like, there's literally tears in people's eyes and the emotion, that they experience, the pride of saying that we own a building like this, or that, we've got rentals and we've got stock market, but we also own, a commercial property. And, in 14 months, we were able to get better than 15% return on our money. And that's generally what I'm going to, pursue and suggest to people. In this case, we significantly outperform that. I wouldn't bank on it, but, I generally am not going to move forward on a deal unless there is a very conservative path to getting someone, 15% annualized on their money. It's just not worth my time, because I know that other deals can produce that. I've got, the luxury of just choosing a couple good ones a year. And so there's not an unlimited numbers of deals like this, but when we're doing, like what you talked about, consistently in front of brokers, we've got a proven track record. They see that we've bought and sold $10 million of real estate in the last 12 months. Like, they want to bring us those deals. All right.
That's awesome. I love that slide. Thank you. It just like,
that's the fun one.
So, yeah, this is awesome. Hey, I do have a question here from one of our audience members.
Okay.
Iraz asks, so can people 1031 into one of your deals like this one?
Technically, I think it's possible. I haven't navigated that. It's like very much a personal question. Ryan, maybe you have, and you can get to that in your presentation. But there are a lot of considerations that go along with that, with vesting and some other things. So I've also found that some of my investors, just, hey, we want to pay the tax and have a clean way to move along to the next one. Personally, I don't do 1031s. I'm shielding almost all of my taxes through depreciation and cost segregation so that I'm not obligated to buy a deal or overpay because I'm on a 6-month clock.
You'll have to have another webinar, Leka, to go through
yes.
that. You can do it.
I'm so excited. Actually, my next webinar is cost segregation. So
okay.
For that.
No, you can 1031 exchange into these things, but you got to do it through a tenant in common, and it's a little bit different than just investing directly through a syndication.
Yeah, and this is the way that I've done it is just a very simple structure. Everyone's got their proportional share of an LLC, right? Just like you would any other company, you own a piece of that. Okay, where are we headed? Oh, timing. So, I mean, this might be the most exciting thing because of what's happening right now. I mean, generally, I would say it's kind of silly to try and time the market and the opportunity cost of, not participating, waiting for the dip. You would have lost 10 years in this last run up. And so, I think about timing someone's situation, right? And finding the right seller to work with who at that moment is very motivated, who's going to allow us to buy something significantly below replacement cost, who will cooperate on seller financing, who for whatever reason has a problem and we can solve it and add tremendous value. And so, that is what I focus on first and foremost. But, we are in a fortunate position that right now we know what's coming because a couple of specific factors. We know that commercial mortgage-backed securities are starting to come due and that values are dropping and tenants are being lost. And there's going to be a lot of people who just don't have the ability to refi in the loans that they're currently in. So some of those folks are going to be forced to sell, or they're going to end up as bank-owned REO properties. And that was, the deal before this one. I bought it from a bank and it was mismanaged. And so that is a big factor. Another one is my tsunami is just the fallout from what's happened with shelter in place. So think about this for a second. A lot of these businesses, unfortunately, aren't going to make it, which means they're not paying rent to their landlords, which means the landlords aren't being able to pay their banks, and commercial mortgage-backed securities are not cooperating with those landlords on their payment terms. And so right now, just in Arizona, where I focus, 80 buildings are on the watch list because they've fallen behind on their payments. Hopefully most of those come out of it, but there's going to be a percentage of them that don't. And when I couple that with interest rates that are at a lifetime low, I couldn't think of a more exciting time to pick up deals at what's probably like the cost basis of a lifetime. If we understand what we're buying, right? And we're thoughtful about it. And, you're buying better located real estate that's going to be someone's first choice, that we have the ability to, let's say, beat the competition on rent rates and just make sure that we can deliver a really high value property for our tenants to lease while having, very conservative loans or debt structures that are going to allow us to, be strategic and smart and mitigate risk as much as possible with what we know is happening. So I think, there's some things that I wouldn't buy now, given what's happened with COVID, that I might have 2 years ago. But fortunately, we have a much better sense of what that is. And so I think we can be very picky. It's really started to shift from being a seller's market to a buyer's. And I'm just spending more time getting my friends and my family educated and comfortable with what's happening so that they can take advantage of kind of this, everything that you see here on this slide, right? And you put all these things together, and to me, and to the folks who've been able to participate in my deals, that's time back for them. That's money back for them. That's compounding returns. And I think it's allowing people to do, what they want to do when they want to do it. So I covered a lot there. I think there's a ton of questions. I know we'll spend some time on questions, but I do have a few things that I have for you guys if you're interested. I've prepared the same personal financial statement that we use with banks to get loans is available for download on my site, along with Cash Flow Secrets, which is kind of my manifesto, my investor toolkit, a bunch of resources that I use. And so, if you guys are interested in seeing my projects or getting to know me better, just head out to simplifiedproperties.com. So that's where I maintain kind of my wait list as we're anticipating the next deal's arrival. My toolkits, downloads are up there. And then, what I've started to put together for folks is it's basically a video series and a guide on all the things that someone would want to understand and know before moving forward on a project. So Leka, maybe that answers, 90% of people's questions. And I'm going to take a 1-minute break, and people could jump out there to the site if they want for a moment, and then I can come back and we'll do as much Q&A as you think we have time for.
Yeah, that was amazing, Sean.
That was a lot in 20 minutes.
That was a lot, but that was so good. I'm just so excited for everybody watching. That was a lot of good information. And what Sean mentioned before, the personal financial statement, I actually just downloaded it myself last week. And it's got such great information to send to your lender or anyone you want to get a loan from, or your private lenders. And it's just a good thing to have, even for your own knowledge, that what is my net worth? What am I going into this next deal with? It's great to have. Thank you for that.
So Leka, do you want to find a few questions or prioritize those and we'll answer them, or how do you want to?
Yeah, if you guys have any questions, please put them down in the chat box. We can always come back up. Alex, do you have something that you wanted to say?
We can probably put you live on the program. First time caller, long time listener, Alex, everybody.
Yeah. Here, I'm letting you. You're being allowed.
Alex, you're unmuted.
There you go. Yes,
you can.
Okay, so fantastic information. Thank you for sharing, you guys. What I wanted to ask is, someone like myself, I'm a full-time fix and flip investor in Los Angeles, and I'm interested in investing in more cash flow properties. How would you recommend that I start to explore that arena more? What would you think should be my first step?
I forgot to answer that in my presentation. And so this is one of my biggest, probably missed opportunities or mistakes, in that I lost at least 3 years, if not more like 4 or 5, trying to fumble my way through a lot of this. I think the more strategic way to do it would be to align yourself with someone who's already doing deals, participate on one of those. And so you can learn while you earn in the passenger seat. And then if you want to go out and, eventually start to spearhead more of your own, you've seen it done. You've got a resume of deals that you've actually been an owner of. And so you can say, yeah, I've already owned 4 shopping centers. So, this deal, I'm going to take more of a lead role, but this is how we've done it historically. And that might be on a market that you're in, but I wish I would have done that, because I would have been making money. I would have had more in portfolio, and going out and talking to the commercial brokers. They're like, yeah, so what's your resume and what's your bio? Oh, you've never done a deal before with a shopping center. You've never done a $4 million transaction. Like, great. I'm going to take a lot of time and a lot of energy to teach you how this is done on what might feel kind of like a long shot to them, versus someone who's been transacting back to back to back. Good question, though.
Thank you.
Thank you, Alex. I have another question here from Kim, who says she owns a small retail space. So she wants to know, how do you find your tenants?
Good question. I'm a big believer in brokers, so I always hire a leasing broker. But I think different than a lot of landlords, particularly some of the, how should I say this? More seasoned in some of the older demographics, I will do a lot of things to support them, kind of from a headquarters standpoint. So I'll drive traffic with paid advertising. I'll do marketing campaigns, and I'll do things to actually bring warm leads to their door, so that they can basically have a jump start or accelerate that. Because the faster we can lease that space, the faster we can boost value. And I think a lot of marketing campaigns that can go into that. I'm a believer in putting things on LoopNet Premium. I shoot videos. I do high-end photography. Everything that you would see done in, let's say, residential, it's like commercial is shockingly behind. It's like, even if you do a mediocre job, you're probably way ahead of the game.
And do you have property managers and manage these, or are you doing that too?
Yeah, I'm a big proponent of that, because we'll let them with their economies of scale, right? Like, so we might have 3 or 4 buildings in our portfolio, but they might be managing 40. right? And so now they've got the software and the systems to run this at a high level, to deliver monthly reporting. And so it's like, I can see that, all of my investors can see that, there's complete transparency. And I would rather personally spend my time, helping to lease that property up faster, which is really going to create more value and juice those returns more, than dealing with property management, which is, a lot less valuable when it comes to an income standpoint.
That was great, Sean. That was great. Thank you so much. And you guys can keep putting in your questions here. If you have them for Sean, we'll come back to it again at the end of the webinar, okay? So let's take it over to Ryan.
Hey, everybody. All right.
Hey, Ryan.
How you doing?
Good.
All right, let's get this screen shared here. Get this going.
Okay.
So hi, everybody. My name is Ryan Gibsonn, and I'm with Spartan Investment Group. We do primarily self-storage. So we're going to just talk a little bit about that. Just quick background on me. My business partner, Scott Lewis, and I founded the company back in 2013. We've raised about $25 million in equity to date, and we have about just under $100 million of projects underway. And we've had 9 projects go full cycle. So go from buy, build, operate, and pay out investors. It's kind of fun where we started. I was an airline pilot for Alaska that moved me out to Seattle. Scott's in the military in the Army, and served in Iraqi freedom and is a disabled vet. And our mission basically was to improve lives through real estate. And if you look at the picture in the middle, the house on the right is actually Scott's house, and the white house on the left is my house. And one day Scott was walking down the street, and I walked outside. I had renovated my house down to the studs. This is down in 2009. This is in Capitol Hill, Washington, D.C., the other Washington. And the house in the middle represents the first deal we ever did. And, Scott and I basically started the company by flipping houses. We ended up flipping about 4 houses just on this street in Southeast DC. And, we really helped out the sellers. We went after the deals that had a lot of title issues. They're in foreclosure, back taxes, very difficult properties to buy and renovate. For those house flippers out there, our criteria was 50% of ARV. So now in today's market, you might get 75 or 80%. This deal in the middle, we bought for $100,000. We put about 160 into it, and we sold it for 550. So we went for those deals that the owner had died and there was probate sales or tax liens and things like that. And so there's a lot of title work to do. So,
Ryan, is this the house that burned down?
No, that's in a different section of the city. Yeah. So we restored several houses that were burned down in fires, and kind of made them nice and sold them. So there's a lot of houses in DC that were vacant and boarded up in certain places. A little bit about last year. We really grew last year. We have about 13 employees now at our company headquarters in Golden, Colorado. And we have about 30 employees throughout our network that are Spartan Investment Group employees. Last year, we distributed about $500,000 in cash flows to investors on a monthly basis or a quarterly basis. We raised about $11 million in equity. We look at about 1,000 deals a year. So we only do about 4 deals. We do about 1 deal a quarter. Made about 19 offers. We onboarded 91 new investors, and we added just a little over 1,000 units to the portfolio in 2019. Just by the numbers, this is our team. Again, about 97 million under management. We have just over 4,000 units in our portfolio. And we have about 1,500 investors in our network, and about 208 of them are active in our projects. So we've done pretty much the gamut, as you said earlier. We've done everything from taking RV parks that were producing $250,000 a year of NOI and increasing the operations to be $650,000 a year of NOI. We've taken subdivisions and subdivided and sold off lots to developers. The middle one is a condo conversion we did in DC. Leka, you saw me present on that one at Charles' event.
Charles' event? Yeah, that was amazing.
Yeah, that was a good project. So we
That's a
basically
great
took an
project.
old row house and converted it into a condo building. We went up 50 feet, back 25 feet, and then we actually went down 10 feet, and then created a condo. And on the project to the right, we do land entitlements and self-storage development ground up. We also buy self-storage projects existing, and then we add value to them through adding on additional units or through operational efficiencies, which we'll talk about on today's case study. The project on the right is actually Black Diamond Self-Storage. This is in Washington, and we broke ground on it yesterday. It's a 755 unit, 100,000 square foot facility, and we did the whole thing. So we took it from identifying the parcel to taking it all the way through its construction. This is just a snapshot of our portfolio. We have, I think, 11 properties now in our portfolio. This is just kind of a sampling. We do everything from, kind of value add storage to RV parks. And in the bottom right, we've actually got a unique deal, which is manufactured housing in Sequim, Washington, which is a brand new manufactured housing development, which is a very rare thing that people can do. I don't think there's been a project like that built in Washington in probably over 20 years.
And I'm very excited about that project because Ryan's going to fly me there in about a month.
Yes.
And he's going to literally fly me there on a private jet, Ryan. And show me this
172.
property. Yeah, that's awesome.
Yeah, so this is basically what we want. This is our target property. It's kind of our bread and butter. So if you look at the top property on the top right, that was an 11 building self-storage. It had about 750 units. It had a car wash. Kind of didn't really care for the car wash too much, but it came with it. Had U-Haul rentals, and it had FedEx UPS drop with some retail sales of boxes and things like that. Cash flow day one, but then it had this big orange box, which represents the land that we could expand. And we're building 40,000 square feet on that property today. That construction actually broke ground this week as well. So we'll add on those additional units, lease them up, and then so we'll make money by increasing revenue and getting the multiple on the exit with the NOI, and also by expanding additional units. The bottom right, that's the Black Diamond one. That's a ground up development. That's also what we do as well. So this is where we look. We look at the best markets. So if you notice, Oklahoma has got a big old blank spot because self-storage rents in that state are so low that we can't justify what we offer from a competency perspective, which is development. So you can't justify the additional cost to expand storage in that market, so we don't look there. We also don't look in markets that don't have growth, such as Cleveland, Detroit, Chicago, New Jersey, New York. Those are declining population markets. We generally look in markets that have rising growth, rising population, strong rental income, and have a general net migration of people. So this is actually on our website. If you go to spartan-investors.com, it's on our main page. You're welcome to look around at that. You might say, man, you guys are all over the place. You're looking everywhere. And that's really because there's only 55,000 self-storage facilities in the United States. So there are millions of multifamily buildings. So, when you hear about multifamily focusing on one market, it's a little easier to do because you actually have the deal flow. So everybody's talking about COVID. So what happened during COVID? Well, a lot of good things happened. These are specifically our self-storage properties. And we saw a 7% increase, for example, at Aspen Park Self-Storage during COVID. This is clocking from March 1st to May 31st. We saw a 4.2% increase at Mini West, 1% increase in Devonshire. That was a storage that we recently purchased. And then we had 50 new leases on Fort Worth Hotel and Storage, which is the property we're going to talk about today. It's actually closer to 58 now. And those all happened during COVID. So regardless of what was happening, the shutdowns, people were still transacting and renting units in that business. And then we recently bought a Macy's that was converted into storage that we're taking through lease up, and we saw over 40 rentals. I think it was closer to 50 or 60 during COVID as well. So very
Ryan,
good business.
just for fun, tell us,
Sure.
What is one storage unit rent for a day?
Sure. The average is $100 a month, an average unit. Yep. And it can vary. So we have units that rent for as high as $450 a month, and we have units that rent for as little as $50 a month across the portfolio. And one thing I forgot to mention, we're doing all the asset property management Our corporate staff is, set up. We have an asset manager, corporate property manager. We have a property admin, and we deploy and hire directly all the employees at the site. We do all the development in-house, and we also do the acquisition and the syndications and the capital raising all in-house. So totally vertically integrated. We just want control. We feel like we can, have a better alignment of interest because but we can focus truly on the NOI, where the rental company, the property management company, might focus just on a percentage of gross income. But this is the case study we're going to talk about today. This is a boat self-storage facility. It's 60,000 square feet, Fort Worth, Texas. It has 209 units, and we were open during COVID, so we never shut down. This facility is mostly unmanned, so we didn't really have any employment issues here or real strong restrictions with the facility. Like I said, we saw about 54 new leases from March 1st to May 31st. Storage is considered essential in most markets throughout the United States. And we have no rental increase restrictions. We have no auction restrictions. We have very little restrictions imposed on us, like multifamily or some of the evictions that were imposed. Now, in some states, the Association for Self-Storage encouraged folks to work with their tenants, and we always do that. And they kind of discouraged rental increases, due to the sensitivity of what was happening with COVID and delaying auctions and things like that. For most of our properties, we took a very case-by-case basis. If the tenant was, consistently late or always behind, we would still enforce the auctions. If it was kind of a new problem, we kind of took it case by case during COVID. So here's what we bought. It was pretty much garbage. There was a tree growing out of the building on the top left. The signage was what you see in the bottom left. Very, very unattractive. About 25 of the units were piled full of abandoned trash. Took us, I don't know, maybe 15 or 16 dumpsters to get rid of it all. We bought it for $1.335 million, which equates to about $22 a square foot, which is where the value was, because we could buy something that costs far less, about half as much to build. So in storage, a property of this caliber would be about anywhere from $45 to $50 a square foot. And that doesn't even factor in the cost of the land. So we got the whole thing for $22 a square foot, which is incredible for us. When we bought the property, it was actually losing money. So it was losing about $21,000 a month or a year of NOI. So it was in the red. And the cap rate, I don't really know. The cap rate we paid on it obviously was negative NOI. So it's probably a negative cap on this point, right? But we'll talk about why we want to buy it. So sell price about 4.382 is the projected sales price on a 1.335 purchase. So there's about a $3 million spread in there, just a little bit more than that. 4.495 million in profit is what we expect over a 4-year hold. And that's all the cash flow from operating returns plus the sale. And then the market cap currently is 6.25%, but in our underwriting, you'll see we actually increase cap rates in our pro forma. So we say that cap rates are going to get worse as the deal goes longer, because it's, you can't predict that the cap rates are going to be the same or lower in the future. We just assume that everything's going to get worse. And we projected a 4-year hold. So I'm going to go through kind of what we've deployed and kind of where we're at today. So the reason why we were attracted to this opportunity is because this facility was primary for boat storage and RV storage. We looked at how many boater registrations there were in the city of Fort Worth. And if you notice here, you can't really see it very well, but in about 2009, this chart goes through the roof. So we saw that there was over a 500% increase in boat registrations in the city of Fort Worth. And then we said, okay, how many of those boats are below the length of the units? And I think it ended up being like 450%. So we knew that people were getting boats there. And we looked in the occupancy of the market was 100% occupied or close to it. Mm. So we looked at this subject facility and we said, okay, what's going on at this property? Well, it was 14.5% economically occupied. So needless to say, when you let trees grow through buildings and you let trash collect and you have a broken phone number, a broken website, no SEO, you're not listed on Google, you don't have any promotions or advertising, nobody's going to book your facility. And not only that, if you make it very difficult for somebody to transact and rent your business by not having online sales or a website or a staff member or a call center to answer when you call, you're going to make it very difficult for somebody to want to book your facility. So basically, the operator was a hot mess, so to speak. So we had about 44%, and I put quotations there, 44% physically occupied. And that meant when we got the rent roll from the seller, we looked at the occupied units. Now, when we started making phone calls to actually collect on these tenants, people were like, I stopped renting that facility about 5 years ago. So we noticed that a lot of people were physically there on the rent roll, but they weren't actually there. So as we figured that out during our final due diligence period, we took that, we discounted the sales price with the seller because we wanted to match sort of what the value that we were buying. So $22 a square foot is pretty bottomed out, at the end of the day. And the rent roll is an absolute mess. We took a long time to go through and really reconcile the rent roll for the property. So where is it at today? We're 47% economically occupied. That was a 67% increase. We bought the facility about, I think 8 months ago in September. We've had a 27% in physical occupancy over above what we had before. And we've increased the annualized NOI by $69,000. So we went from over $80,000 when you consider it was a $21,000 a year loss. Now we're booking a $69,000 annualized NOI, which is about a 1,300% increase. And we had the rentals during COVID. So I really wanted to kind of go through what we did and how we made this project really just be efficient. And, and real quick, I just wanted to explain the difference between economic occupancy and physical for those wondering how you could be different. It doesn't mean we actually have almost zero delinquencies. Everybody pays on time. So if you're like, well, then how come you have a decrease in economic occupancy? The reason why is because imagine you had a building that was 100 units and it was 100 occupants. You have 100% physical occupancy. So if you have 100 units, 100 people are renting, you have 100% physical occupancy. However, if the rent was $100 a month and the average collected was 80, you'd have 80% economic occupancy. So the way we sort of look at economic occupancy is we say, okay, when we're moving somebody in on a promotion, they're not paying the full rent. So we may give them a month off. We may give them first month free. We may give them the third month at a discount, whatever it might be, so that we can start attracting tenants and really incentivize people to book our property and lease it up very quickly. So that's the difference between economic and physical. As the fall progresses, our rental rate increases are going to be taking effect in July and August. You're going to see the economic occupancy start to rise. Now that's only internal metrics. So if we look at, the $100 a month and people are paying 80 on average, you've got 80% physical economic occupancy. Mm-hmm. So if you raise your standard rents to 120 and people are still paying 80, now your economic occupancy has gotten even worse because you're benchmarking it off what the marketed rate is of your property, if that makes sense. So a lot of numbers and things like that. But at the end of the day, zero delinquencies, very good physical occupancy, and rising rents as we take the project through. So how do you do this? Where does the money come from? How did we stack the capital stack? Whoops. So the first thing that we do is we have to figure out how we're going to write our business plan. So we write a business plan for the property, we share it with our investors, and then we make the best decisions on how to spend the money and how to deploy the capital and what we need to basically complete the mission. So if you look to the left, I have equity in blue of 1.75 million and I have debt 0. So on this property, we didn't want to mess with a loan. The seller wanted to be wiped out. He didn't want to do seller financing. We didn't want to screw around with a bank loan. And we ran the numbers and we said, we can get investors a near 20% annualized return on this if we just do it all equity. And guess what? The risk of having loan default is 0 because there's no debt. So no debt on the property, 100% equity. That's the way we decided to do it. So if you look at the total raise, that's 1.75 million in the middle. And then we have 1.335% going to the purchase price. So that's on the top right. We used $280,000 to improve the property, to paint and put in signage and pour new rock and fix doors. A lot of doors were broken, needed to be replaced. We paved some of the inside of the units that had crushed rock. We put in a new gate. We put in new security cameras, did a lot of things with the construction. So we just line itemized the construction budget. We make fees. So when we buy a project, we actually pay ourselves. So when we buy a project, we have some acquisition fees, and then we pay ourselves project management fees. So that's how syndicators and syndication companies make their money. Then we put in $40,000 of loss coverage in the pro forma, because remember, like I said in the beginning, we had a minus $21,000 losing property, right? So you have to account for the lost revenue that you're basically buying a business that is bleeding. So you have to account, okay, how long is it going to take me to get the business up and running? And we were losing about, I think, $6,000 or $7,000 a month at the end of the day. So we put $40,000 in loss coverage in our pro forma, or in our capital stack. And then we just had $50,000 put away for just rainy day. So if you add up all these numbers, it equals about $1.75 million. And that's basically what we did with the money in the project.
Hey, Ryan, I have a question.
Sure.
On project management fees. How do you cap that?
Sure. So we take the total project cost, which in this case is $1.75 million, and we charge a 1.5% fee on that. So we would charge, in this case, $36,000 or $38,000, something like that. That's our acquisition fee. And then project management fee is, I think, 3 or 4% total project cost. That's paid out over a period of time as, you know, there's milestones completed. And so if you add those two numbers together, it's about $105,000. So here's the business plan in high level, right? So that's the sign we had made, a 30-foot sign pole. We rebranded. So the property, we changed the name. We called it the Boatel because that's where, indoor storage, boat storage. And we came up with a logo, color scheme, stationery, all the rest to really, get that good feeling of who we were. So capital improvements, that was the first thing we did. Before you go market and advertise and get everybody excited about your facility, you want to make sure you're offering a good product. So we went out there, we did the crushed rock, we fixed the buildings, we made the repairs, we moved the gate. We really focused on making it a quality facility before we really turned down the marketing engine. The step 2 is operational efficiency. So before we market, let's make sure that when a customer calls, they're going to have a good experience. So, when you call the facility, somebody's going to answer on the second ring. It goes to the call center. They can book a unit right over the phone. If they're sitting in front of the gate at the front of the property, they can book on the call center right away, or they can go on their smartphone and book on the app and get assigned a unit right there. So they don't have to meet anybody or go through a leasing agent or anything like that. They can do it right on site. And then the step 3 was to turn on the marketing engine. So we turned on the marketing engine in about April this year, or maybe even a little bit later in March. And I'll go through some of the things that we did with that. So I mentioned the call center.
So another question, do you actually have people sitting at the physical location?
Not this property. So most of our properties have usually 2 to 3 staff members that are manning the office and manning the facility, depending on the size. This one, we do have an employee there, but he's very part-time. He's more of a maintenance, and he helps the customers and he helps do things on the property, but he really is there for, on a part-time basis.
So you have one call center that manages all of your facilities?
Yes.
Awesome.
So one thing that the boaters wanted, so before we take over any property, we always survey our customers. So we go there and we look them in the eye and we talk to them. We say, hey, we're buying this place. What don't you like about it? What would you like to see happen? And so we do a customer satisfaction survey or a customer survey right away before we take over the property, while we're even under contract sometimes. And they really wanted a free air station, right? You got your boats, you're going out on the water, whatever it might be. So we installed a free air servicing at the, kind of closer to the front of the property. The other thing they wanted was just a better crushed rock to help, them drive in and out of the facility. Another thing we did was the gate was so close to the facility that when you were pulling into the property, your boat was hanging out onto the road. So we moved the gate back about 30 or 40 feet so that they could pull all the way in and not have their boat hanging out in the traffic. So that was one thing that we did.
They're like simple little tweaks.
Simple tweaks.
Simple tweaks, but so effective.
Absolutely. And you can see the picture on the bottom right, it's not very good, but we have the sign now. So if you notice the first slide, the sign was, facing the field across the street. It wasn't facing traffic. So we want to make sure that we're very visible. You can see the banner signs that we put in the road, the banner flags, put up an American flag. You can't see it here. We have a boat podium with a boat on it to kind of give the who, what, and the where. We have a signage with our number on it. Very, very easy to book, very easy to see how to book the process. So, and that brings me to our customer journey. So this is kind of the process that we set up on our properties. So you can visit our website, dfwboatstorage.com. You can pick your unit. You can fill out the information, sign a lease, complete payment, and you have access to our property.
That's amazing. It's just so user-friendly. I love it.
Yeah, that's our goal. So this is a little bit of our website. You can kind of see, again, just very clean, very simple. You can log in. You can make a payment. We get everybody on auto pay as much as possible, or electronic funds transfer. We don't take any cash. We really make it as efficient as we can to make it easy to pay. Some of our digital advertising. So we went and we did SEO and digital advertising, Google AdWords, and promotions online and in the community. So we went old school. We looked up all the boater registrations within 3 miles of the website or of the property, and everybody who owned a boat within 3 miles of the property or so got a postcard, and it said, "Hey, book today and get a month free," or whatever it might be. So we sent out, I think, about 1,500 or 2,000 postcards. We did digital advertising, social media advertising. We always kick off a referral program because that's usually a massive source of our bookings. So refer a friend, get $25. And then we use a website called Sparefoot. That's a kind of a SEO optimizer for storage. It gets you high in the rankings so that you show up first. We did AdWords and a couple other things. So this is, we actually did a billboard. So there's this massive Lamar billboard right above our property. And we were like, hey, let's just rent that bad boy. So we threw up a billboard. I think it wasn't very expensive. I think it was like $500 for 6 months or something. It was very cheap.
Wow.
And that's an example of our postcard below with our move-in special. We go to the Chamber of Commerce and we register. We go to local businesses and we give them swag. We make deals with hardware stores. We go to the marinas. We do a move-in special. We increase the signage. We make it easy to book. If you go to our website, it's easy to book. If you call our call center, it's easy to book. And it's easy to find us. I kind of joked when we first bought the property, our property inspector came by. He couldn't find the facility because it wasn't even on Google. So it's it's one of those things where just simple things to really position your property for success. So I did this before, and let me see if I can. So we did customer testimonials. So Tim Krause from Video in Washington. That Leka's your awesome business card, virtual business card.
Yes.
I show that to like everybody. That thing is like so cool. He flew down to Fort Worth, Texas, and he filmed all of our properties. We actually invited a bunch of happy customers to our properties, and we did testimonial videos. And what we did was we just flood YouTube with like 7 or 8 videos. So when people are searching for your property, they find YouTubes on your business, so you can see what we're doing. So I'm gonna see. I know there's a setting that I can play share computer sound. I got it. So here we go. I'm gonna play one of our customer testimonials. Let me know. Give me a thumbs up if you can hear it.
Okay.
Let's see here.
I would definitely recommend Boatel to my friends and family. The big thing that I see here is a solution that offers value to anybody's storage needs. The things that I like about Boatel that gives me a little bit of advantage over your competitors is I have electricity and lighting that I can use to go do some work on my boat or prep it before I want to take it out. Additionally, there is free air that I didn't have before, so I can always check my tires before I go on the road.
So like any So like any property or video production, not only did we do that, but we made a longer video and then chopped it up, right? And then you can just flood the internet with those videos. And then that way you become more searchable in Google and SEO. So last thing we did here is AdWords. AdWords are a pay to play. So AdWords are what are people going to be looking for So if you look Fort Worth boat storage in the search bar, you can see that we are the top hit in Google. So we have a 5-star rating with 4 reviews. So you want to make sure that there was no reviews. We weren't listed. We weren't doing average. So now people can find us if they're looking online. And we actually did a very extensive customer survey of all of our properties across the portfolio. And people find our storage properties 2 ways: online and a drive-by. And everything else is just small, small things. And then referrals. So that's really kind of our source of our customers. So getting into the brass tacks of this and really getting into the financials, I wanted to just pop open the hood and show you guys, kind of the breakdown here. So this is our typical underwriting file. I'll kind of explain it for you guys. So this M1 is month 1, month 2, month 3, and I did it all the way through month 12. These are our typical revenue sources. So in this case, we typically have storage rents, RV rents, and other rents. So in this case, we're only renting storage here. We are going to kick off RV rentals here in the next couple of months, but for now, that's pretty much it. So on the top line, you see that's the gross potential rent income. So that is if you take every unit size, throw it into the spreadsheet, that is our gross potential rent income. And you can see it ticks up as we go forward in the project and raise rents. If you see here, we start the underwriting file at a 13.54% economic occupancy. So I talked about 14%. 13% is a little bit below that, but we just were a little conservative starting the underwriting file. These are all the things that we make money on. We make money when somebody doesn't pay their rent. We make money when we cut somebody's lock. We make money on administrative fees for booking, and then the rest, right? So our gross operating income when we took over this property was about $33.80. So not very much money. Now let's focus on that month 1 and let's just look at the expenses. So here's the expensive, right? So you've got bank and credit card fees, you have insurance, you have landscaping, you have legal, you have marketing and advertising that we're spending on, right? So you can see our expenses were $10,000. So we're losing capital. So, you might be saying, well, Ryan, I thought it was $21,000 losses, before. And that's true, it was, but he wasn't trying. He wasn't getting out there and marketing. He wasn't insuring the building properly. He wasn't paying staff. He was doing it all on his own. He wasn't hiring a call center. He wasn't doing all these things. So, it's kind of like, scared money don't make money, right? Mm. I mean, if you are afraid to spend money on your business and you're afraid to put your neck out there a little bit, you're not going to bring in the customers. So we have a very specific marketing plan, very specific capital plan that is going to essentially turn that revenue around. So at the end of the day, we pro forma all this capital, and then we have all these expenses. So if you look in about month, so each column here is a month. If you look in the 12th month here, net operating income is actually we're right here right now. This is for the month of May. We're supposed to be making about 1,078. So as of today, based on our lease up and where we are in the project, we're supposed to be making $1,078 a month in net operating income. And remember, there is no net ordinary income in this case because we have no debt service. So basically, that's where we are today. However, we've been exceeding everything. Our lease up is going better. Our expenses are lower. We're bringing in more revenue. So this is, I actually pulled a snapshot of our P&L. And this is just isolating the month of May. And you can see down here, our net income was $51.58 for the month. So we're pacing about $4,000 a month higher than we projected. And we only expect that to continue increasing because we're more occupied, we're more efficient. All of our capital improvements are done, and all of our marketing and advertising has been deployed. So that's one other thing we do for our investors is we do financial reporting. So this is kind of a fun graph, and I'm happy to share this with the group and what we do. But basically, this is an analysis that we send out. So we say, that big underwriting file has got many cells and many rows, but we want to boil it down to what do people care about, right? How are we doing versus pro forma and actual? So if you can see our revenue analysis, this is essentially all the income that we're bringing in, gross income. So you can see when we bought the property here, in the first quarter that we owned the property, we were supposed to bring in $33.80. Remember we talked about that spreadsheet, right? We actually brought in $61.12. So we brought in more revenue than we anticipated. So this bar chart really helps investors understand that, hey, we brought in for the third quarter of 2019 more revenue. In quarter four of 2019, we were supposed to bring in 14,000. We brought in 24, and so on and so forth. So every quarter you can expect it. So when our Q2 results come out, the investors will be able to see that we brought in, I believe it was about, I think it's pretty close to be about 50,000 for the quarter. So quarter two will bring in about 50K. On the expense side, you want this solid line to be below the dashed line, right? You want to be spending less than you perform us. So you can see here, the first quarter is a little messed up because we do things on a cash basis, but you can see generally expenses are annualizing or averaging less than what we projected for expenses. And this is the NOI. So this is how people actually make, this is how you actually make money on the property. We knew we were going to go down, right? When we start cleaning up, we start spending money. And now we're starting to go up just as planned. So we pretty much did what we expected to do last quarter. And we were a little bit above on the previous quarters. So that's just kind of something that we do to kind of, investors want to know, like, sometimes I'm on passive deals and they say, well, we're 90% occupied or whatever, and you get your distribution, but at the same time, you're not really, you're not really sure, like, are we progressing per our business plan or not, which is what makes this helpful. That's all I have.
That was awesome, Ryan. That was such a good, clear picture of, now I understand storage units. Like, I had never really heard this or been taken through it this way.
Sure.
So thank you for that. I do have one important question. How can investors get on your platform?
Yeah, so our website's on the screen, so spartan-investors.com. Our website, you can pretty much watch everything. We do a YouTube channel. We have webinars. You can fill out our list, to get on our list. Like I said, we do about a deal every quarter. You can fill out our intake form. And then we also have a ton of things on there, articles, podcast interviews. We make available our strategic plan. So our plan is, our strategic plan is a 3-year plan that goes to the end of 2022. And our growth plan is to acquire $250 million of assets under management, continue building our corporate staff, and continue building out each facet of the business from a service sense, to service the properties.
And how do these investors get paid? Do they get paid monthly, quarterly, yearly?
Yeah, so after the property stabilizes, or if it's already stabilized when we buy it, it depends. So typically distributions are done quarterly, but we're switching to monthly distributions for investors.
Got it. And do they have any tax benefits for being on this platform?
Yeah, so we do rapid acceleration, depreciation, cost segregation. So everybody who's in this property, regardless of the profit or loss, will get losses on their tax returns. So we get a K1. We do K1s in March. All of our investors get their K1s by the end of March. And the bonus depreciation and cost segregation helps you get a passive loss.
Great. I do have a question from Brian, who asks, so he says that new mobile home communities are rare. So what did the permitting and planning process look like for Squim?
Interesting.
Yeah.
So the land had matter of right, very rare piece of dirt, 38 acres. It was an old dairy farm, and we got the land approved by city council, and the planning office made a recommendation to approve it. And after that, it was pretty straightforward. Most jurisdictions, we look in every market we do storage, and we always kind of ask the planners if they'd be open to it. And we always get a no and don't ask me again response.
Yeah.
Squim was very open to it. We're building a senior affordable housing community that is 55 and up. And these are going to be manufactured houses that are pit set, curb, sidewalk, gutter, landscaped, very beautiful community with a clubhouse and pocket parks and things like that. So it's going to be a kind of a destination park, up in Squim, which if anybody has ever been to Squim, beautiful community with casinos and golf courses and the banana belt. It gets only 16 inches of rain per year, which is, as much as Los Angeles, California. So very, very nice community.
That's awesome. We have a couple more minutes if any of you have questions, and so we'll just give you guys a second.
Sure.
Sean, can you throw your information up there too for a second, just in case
Sure.
people get it before?
I'll just type it into the box here. Maybe
Yes,
people
go
can
ahead.
hyperlink that way.
Ryan, if you want to do the same too.
Yeah, sure. Put our website on there.
Additionally, if you guys want to connect with me on social media, it's all at the bottom of my website, LinkedIn, Facebook, all that good stuff.
Ryan, Alex does have a question. He says, what is the minimum amount an investor would need to commit to invest with Spartan?
50,000.
Okay. Sean, do you have a minimum commitment?
I've been doing 100. There's been a couple of friends that I've allowed to come in a little less than that, but for me, the fewer the better.
Yeah.
I'd rather not have a ton of small investors.
Mm-hmm. Got it. Well, thank you both so much. No, go ahead.
I saw one more. It looks like asked for Ryan, when you bought the Botel, did you buy the business and the land?
Everything. Land, business, everything.
And then I don't know if this got answered earlier or not. Ezra, looks like he was asking about getting into apartment buildings. What would you recommend? I would say look very thoughtfully at a property manager. And then if you can invest alongside somebody versus just going at it on your own for the first try, that would have saved me a lot of brain damage.
Mm-hmm.
So I'll add on to that a little bit too. The first time I invested in storage, I invested with another operator. Unfortunately, it wasn't a very good operator, but I learned. I learned what not to do. I highly encourage, people talk about, investing in education and things like that. I really think that, I really agree with Sean that, if you're looking to get in this space and you really want to learn, find an operator that's very transparent, that has references, resources, and is a good communicator. Because, the thing about this deal, is you don't know what's going on. And, the great thing about syndication is you don't have the ups and downs of the stock market, and you can potentially have higher returns, and, but you're not liquid. So you can't just say, oh, I want to sell my position. So I think what's really important is if you're going to partner with somebody, really understand what their communication process is and know that they're accessible, and that you're going to understand, sort of how the deal is, how the business plan is being implemented, and if it's going well or if it's not going well. Because if you're really hands-on and you really want to learn and there's poor communication, it's a very painful experience. And I'm just speaking from my experience investing with other people.
100% agree with that. And I think each deal varies widely too. Like you might see a value add deal where half of someone's initial investment can be returned at refinance, and that might happen in 12 months. And so if someone puts in 50 and gets 25 or 30, $40,000 back, and then, they're hanging on to it for a long haul, that might make a lot more people feel comfortable. And some of them are just going to be more cash flow plays, very long hold. So, look at each deal. And I think for everyone's preference and taste, there's probably an asset class or category out there where you can find a good fit.
And there's this question for, I think, both of you. So if you buy a property that's only 50% occupied, what gives you the conviction that you can find those tenants?
Market study. So so in storage, people call me all the time, hey, should I buy this land? It's zoned right. It's here and this in location, this and that. Nothing matters. The data is the only thing that matters. So if you don't do at least in storage, I don't do what Sean does. But in storage, it's 100% data driven. We spend tens of thousands of dollars a year in understanding data. It's not a gut feeling. It's not, no offense to realtors, but it's not what a realtor said. It's nobody else's opinion. It's what is the population? What is the growth? What is the income? And what other properties are in the pipeline? Are there 8 storage facilities being built? Did you check the permit records? Because if you think, oh, this is a great market, and then you put it under contract, and all of a sudden you go to the permit office and you pull the permits, and there's 300,000 square feet coming in, and there's only 100,000 square feet left in the market. You're going to build a property that won't be able to lease up. So we have a team of 3 research analysts that's all they do. All they do is look at the market and understand the supply and demand. And then, of course, you have to go see boots on the ground. After you do your preliminary analysis, we put the property under contract, and we go and deploy, and we will go shop every single competitor within our market and understand how we rank in quality among our competitors to make the decision on, okay, can we raise these rents based on the quality of our facility, based on, comparably to the other properties in the area?
Same answer, basically. I look at what is the occupancy rate in the surrounding submarket, what are those rents, and then we can reverse engineer from there and say, hey, we're at 90% occupancy. We can meet or beat those rents and put a better quality, facility out. And so it's just going to be a no-brainer for people to either want to relocate or open in our facility versus the others. And that gives us, I think, a disproportionate opportunity to succeed. Because, in theory, we had a better cost basis versus, let's say, what another developer might have around us.
And I can't stress this enough, too. I mean, that's absolutely right. And, if you don't know the market and you don't understand the demand, you are gambling.
Right.
You're gambling. If you flip houses in Seattle, you might not have to know the market you don't have to know the market. But, generally, if you buy a property at the right value, you can get the ARV, and you can understand that you can make money, right? You understand that. It's no different in these other asset classes, except that every asset class is a little different. And you really have to understand how to assess demand and opportunity. And that really what will keep you out of trouble. In this case, for us, there was a 500% increase in boating registrations, and every facility was full. And then you look at the story of this facility, and it's a disaster. So it was obvious to us that It's not that there's no demand, it's just that this is being poorly operated.
That was such good information, you guys. Thank you.
Yeah.
Makes me want to go out and shop. I'm calling both of you after this.
Sounds good.
Well, I'm going to say thank you again for taking the time, to our attendees for being here, to our speakers for, putting such an awesome presentation together. It was just loaded with knowledge bombs. And you guys have their information. So if you want to reach out to Sean or Ryan directly, you want to be on their investor platform. I mean, they're great resources, solid guys, have been doing this a while, really do their due diligence. So highly encourage, being mentored by them, being on their platform, watching them grow side by side. I mean, possibilities are endless. So I just want to, thank everybody, and hopefully we'll see you at our next webinar, which is coincidentally cost segregation and apartment investing. So we'll see you then. Sean and Ryan, thanks again.
Great to be
Bye,
with
guys.
you guys.
Happy Friday, everybody. Take care.
Happy Friday. Bye.
Bye.